Good morning, everyone. Welcome to our live daily market outlook. We are on Monday, 22nd of October 2012, beginning of the new week with the rather still risk-off tone seen on major currencies, despite some recoveries during the night, as euro is again heading lower after retracing a part of the recent losses from 131.38 that bottomed at 130.12. The positive thing is last week's closure above psychological 130 support. However, the fresh weakness that is emerging now at the beginning of European session does not promise much, as the negative tone dominates on the lower time frame studies on the single currency, and sees the downside still quite vulnerable. The British pound, of course, remains under pressure after suffering heavy losses last week, following upside rejection at 161.78 and then dipped down to 159.89. This is the low of overnight, nearly fully retracing the latest recovery rally from 159.74 to 161.78, keeping, of course, the downside more under pressure as a part of the larger downtrend of the larger downtrend of the British pound from 163.08 that so far bottomed at 159.74. The top performer is dollar against Japanese yen, as last week's close above important and psychological 79 barrier and the break above on the overnight rally above 200 days moving average and previous high in 79.45, also denting 79.65 interim resistance, aiming towards 80.00. Some corrective action might be seen on overbought conditions on the near-term studies, and the dollar Swiss is again gaining traction after a brief corrective action from 92.88 last Friday's high that dipped to 92.54. That was basically initial support, and now heading again higher, seeing more potential for some stronger recovery of the larger downtrend, but this is still seen as corrective, as long, I would say, minimum 93.50 is capping the upside. Top losers are gold and the crude oil, as the oil dipped again significantly from the levels of the upper boundary of the recent congestion at 93.41 was the high of last Friday, dipping as low as 89.83. We are talking about December contract, keeping still the upside intact and seeing the downside quite vulnerable at this point, as current fears and worries about further deepening of the worldwide crisis are so far offsetting the crisis and the conflict in the Middle East. Of course, that causes also the disruption in the oil supply. So far, stronger fears about the further weakening of the worldwide economies are putting more pressure on the oil price and seeing it as a stronger impact, giving a stronger impact to the price against the other factors that are pushing the price higher. More of this, of course, we'll see on our technical part. Just also to have a brief look on the yellow metal that basically cleared our initial target at 17.17. That is Fibonacci support, and dipped as low as 17.13. We are looking for now test of 1700 as a psychological support, as the overall picture remains firmly bearish in the near-term studies, and seeing, of course, more pressure towards the downside with some corrective action currently underway of 17.13, so far 17.26 seen, and fresh weaknesses seem to be developing. A break, as we mentioned in our previous sessions, break below some important supports and the range floors now is opening way for some stronger corrective action. We will elaborate this more in our technical part that will follow shortly. Just briefly to mention to tackle actually our main problem, European crisis, as union leaders will be facing now 2 months of tough bargaining on money, power, and the future governance of the Eurozone before they can boost the confidence that the existential threat to the single currency has faded now. The European Central Bank's pledge to buy the bonds of struggling Eurozone countries in unlimited amounts has changed the terms of Europe's debt crisis. Yet French President Hollande may have been a little premature in declaring a turning point last week after another night of summit negotiations yielded a deal for a Eurozone banking regulator to be launched next year. He said that basically they are on track to solve the problem that for too long have been paralyzing the Eurozone and made it vulnerable. And again, he said having a confirmation that the worst is behind us. More nights of horse trading, I would say, lie ahead between now and the mid-December, in which EU states must agree on a common budget for the next 7 years, closer fiscal union with the more intrusive central supervision of national budgets. That is one of the basically the premises of further stability of the Eurozone, as this step has been missed on the forming of Eurozone. Otherwise, we would not have most likely this situation like it is now. And the possible separate budget for the Eurozone, of course, with more support for the most vulnerable Eurozone states. Currently, we are talking about Greece, Spain, Italy, and Cyprus that is coming in the focus. The Eurozone leaders will need to decide how to keep Greece afloat if, as expected, it reaches a deal with the international creditors to avoid bankruptcy next month in exchange for more drastic spending cuts and structural reform. And then they may face months of uncertainty over whether Spain, which has already been promised up to 100 billion euros in loans to recapitalize its ailing banks, can avoid a sovereign bailout. And of course, above all, the Eurozone is a long way from returning to the levels of economic growth needed to make its debts more manageable and get millions of hungry unemployed back to work. For now, the financial market turmoil that threatened the very survival of the currency area a few months ago has abated at the risk of lulling EU leaders back into the complacency over what remains to be done. The European Central Bank removed that acute sense of crisis by agreeing to buy unlimited quantities of short-term bonds of troubled Eurozone countries that apply for a rescue program and accept strict conditions. Complicating the next few weeks of negotiations, relations among Europe's three leading powers, Germany, France, and Britain, are as difficult as at any time for a decade. The collapse of a proposed aerospace mega merger between European Airbus manufacturer and British defence company BAE Systems over government stakes underscored the depth of mistrust between Paris, Berlin, and London. And this is one of the reasons that we are still far away from some workable solution, as there is always something between the big ones that cannot be agreed. And of course, the main impact then comes on the countries that are more vulnerable, financially less stable, and they are basically impacted. In this case, we have Spain that is now currently in the focus. Greece, of course, as a burning problem for a month, and of course coming most likely Italy and Cyprus that is currently negotiating with the Troika for some rescue as the country is now heavily indebted. The last figures I've been told they are moving around 15 billion euros. This is unconfirmed, of course. From today's calendar, we have basically nothing. Monday's calendar sometimes busy, sometimes not. Today, nothing. So we're going to take a look at the currencies and commodities and see the latest movements. So we'll spare some time on the calendar so we can take a look on more instruments at this point. Starting, as always, with the euro. Just a quick look at now. Okay, you can see the daily chart of the single currency. Basically, the pair is still stuck within the range of 128 and 130.70, with the latest strong rally being quite promising as the price broke above 130.70 previous top and 131.00, but against so far stalled at 131.38. Still in a way positive tone on the daily chart, keeps the upside in focus. Of course, we need to see the clearance of 131.38 in order to refocus 130.70, our main barrier, and resume the larger uptrend from 120.42 towards levels at 132.00 and 132.82. This is the high of 1st of May 2012. A quick look on the lower time frames, where the 4-hour chart studies are losing traction despite the recent recovery, overnight recovery that hit 130.65. This is approximately a 38.2% retracement, slightly above 38.2% retracement of the down leg from 131.38 to 130.13, as the pair found a temporary footstep above 130 psychological support, and they set a weekly closure above 130, still keep some hopes of possible recovery, but quite a negative tone seen on the 1-hour chart, where MACD is still holding below the midline, and the initial bullish momentum that has been gained is now fading, with RSI pointing lower. Stochastic is again giving a negative signal, and the price now attempting below 10 and 20 days exponential moving averages. Sees the downside still vulnerable. As said, quite negative tone also on the 4-hour chart, as indicators are approaching their midlines, and basically main risk will be seen on the loss of 130.12, 130.00. This is also 38.2% retracement of the entire rally from 128 base to 131.38, reinforced by 55 days exponential moving average that is currently starting to move sideways. This is another signal, and the 20 days one is starting to move towards the downside, as said, keeping the downside more vulnerable at this point. To avoid immediate downside risk, we need to see the gain of minimum 130.75. This is the last Friday's consolidation range top, and also 50% retracement. However, to provide the full relief, bounce above 130.90, 61.8%, and 131.00 psychological barrier is seen required in order to refocus 130 at 138 and 131.70. Conversely, of course, the loss of 130.00 is to open way for further losses. Fibonacci supports 129.70, 50%, 129.30, 61.8%, and a very significant 129 support, that is psychological support, will be open on in case of break below the previously mentioned levels. And British pound, as said, suffered heavy losses last week, especially on Thursday, when it dipped from levels around 160.130 down to 160.30, full figure dip, followed by a brief consolidation during Friday, and then a fresh dip lower, and the Friday's closure just around the 160.00 level. 160.05 was the close of last Friday, with the subsequent recovery seen from overnight's dip to 159.89, seen so far short-lived, despite the some indicators starting to point higher in the price on hourly chart breaks above 10 and 20-day moving averages. 20-day one is still pointing lower, with 55 days one keeping the upside capped for now. This is also the level of 160.60, very important, 38.2% retracement, and the consolidation range top of last Friday. Basically, if we see the break above this level, which is quite unlikely according to the current situation with the price, then it would provide temporary relief and allow for some stronger corrective action. As said, the hourly MACD is still below the midline. RSI is pointing lower. Momentum is fading now, with stochastic now turning towards the downside, yet not full clear confirmation of reversal, but still keeping more pressure towards the downside. 4-hour chart, indicators are in the negative territory, some bouncing on the RSI approaching the negative territory, now moving more sideways. As said, minimum 160, 60, 65 is seen required. Above this we have the bearish crossover of 20 over 55 days moving average that is increasing the downside pressure. As a part of a larger downtrend from 163.08, this move is so far seen as corrective, and unless we see the break of 161.50, that marks the bear trend line of 163.08 and the previous high at 161.78 of last Wednesday, and not much to be expected. Otherwise, a break above these levels would be good signal for a formation of the double bottom at 159.74 and 159.89, and will be quite a good bullish signal for a possible further recovery. As long as we stay below 161.50, 161.78, more focus will be towards the downside, and basically more sideways movements, I would say, will be seen as long as the base at 159.78 zone holds the downside. Break below this level, of course, will open way. This is near to there. We also have the 55 days simple moving average, as well as lower Bollinger Band on the daily chart. Quite good support break of which, of course, to open way towards a more significant 159 zone, where is the previous high of 23rd of August 2012, as well as 38.2% retracement of the larger 152.67 to 163.08%. So basically the focus is on the downside at 159.74, strong support, and upside any move that will end below 161.50, 161.78 would be seen as a corrective, and would not produce anything rather than further sideways movements or fresh weakness. Break above 161.78, 162 is to confirm the double bottom pattern and allow for a stronger recovery, as double bottom is quite a good bullish signal. As said, the top performer is the dollar yen, as this morning it rallied further from its recent base built above 79.00. Psychological support 79.21 actually was the low equivalent to the previous high and upside rejection, with the fresh strength through 79.45, the previous high, and 79.40, the 200 days moving average, now opening way for some stronger gains, and probably to test 80.00 as our next target, as interim support, as I mentioned at the beginning, at 79.65. 20th of August peak has been cracked, 79.66 seen so far. Clearly way open towards 80.00, our next target. This is the also high of 5th of July 2012. Back to the lower time frames, overextended conditions, RSI already in the overbought zone, with the more extended studies on the 4-hour chart, currently moving rather sideways, but signaling that corrective action is quite likely. Yet no any firm signal of reversal has been generated, so we can just speculate that due to overbought conditions we might see some corrective action. Good support now lies at 79.20, 79.00 zone, and basically ideally any reversal should be contained at or above these levels in order to keep the current structure intact for extension higher towards 80.00, our next upside target. And the dollar Swiss beginning of Europe is gaining some strength, as shown on the hourly chart, following recovery bounce of 92.14 last Thursday's low that reached so far approximately 92.88. This is the high, just under a 50% retracement of the entire down move from 93.70 down to 92.14. 92.13 I think is the lowest one, correct, 17th of October. Stalling at this point, and the corrective action has found a footstep on initial support at approximately 92.50. 92.54 was the overnight's this morning. Slow and fresh strength is now underway. Basically, we need to see the clearance of initial barrier at 92 and 93.00 in order to break above 93.10. Let's say the 61.8% retracement would be quite a good signal for some further lift higher, and a possible test of our key barrier in the near term at 93.70, 15th of October peak. Some recovery seen on the hourly studies as they all started to point higher, with the stochastic now giving a good signal, and the price currently breaking above a 20 days exponential moving average that is still in a sideways mode, while 10 days one is starting to point higher. That gives the good signal in the very near term. We're focusing the 92, 90, 93, 00, 93, 10 as our initial barrier, break of which will be quite a good signal for further extension higher. On the higher time frame, 4-hour chart is gaining bullish momentum, but still MACD, despite pointing higher, is still in the negative territory, and stochastic is still in the bearish signal so far, with the RSI currently holding around its moving average. No clear signal higher, moving sideways. As said, we need to see break above 92, 890, 93, what is also the 55 days exponential moving average, in order to confirm and move the indicators of the 4-hour chart into more positive territory. That will give us a fresh signal of further corrective action of the larger 93, larger down move from 94.30 double top to 92.13 so far. However, formation of the double top pattern at 94.30 zone, with price still holding below the main bear trend line, currently at 93.20, and the 200 days moving average firmly capping the upside, and the 55 days moving average crossing below 90 days one sees the more pressure towards the downside as a part of the larger downtrend from 99.70, with the break below 92 as initial support, likely to open a way for a full retracement of 90.41 low of 1st of May to 99.70 peak of 24th of July. The open way for full retracement of this rally. As said, near-term relief will be provided in case of a break above 93, 93, 10, 20. We have the Fibonacci 61.8 and the trend line resistance. That will be a good signal for further recovery, and will slightly offset the current impact of the double top as a quite bearish signal. But according to the current situation in the market, a more likely scenario will be a further extension towards the downside according to the technicals. On the daily crude oil chart, as we can see, ADX is still showing no trend at all, rather sideways movements, while initial uptrend on the 4-hour chart has been lost. Again, we have no direction, while the hourlies as the immediate indicator are showing fading uptrend. This is the base, this is the bounce of overnight's low at 89.83. Back to the larger picture, the price of oil is still congested under 93.50, 60, the recent range top, where the 55 days moving average keeps the upside capped, with the violation of the downside supports 90 zone, and break below 90 days moving average, seeing more pressure towards the downside and the possible further extension lower, as the upside remains firmly capped and current congestion does not allow the price to break higher. As mentioned, the more stronger impact is on the current fears of the weakening Eurozone countries' economies, keeping the more pressure towards the downside. As said, significant is loss of initial support at 90.00. 91 is the, first of all, the 90 days moving average, and then 90.26 is the previous low, as we dip to below 90 as psychological support. Daily structure is still quite negative. Most of indicators are below their midlines. 4-hour chart shows signs of recovery, but a negative tone that dominates, and already indicators again starting to point lower, as the initial recovery was capped under initial resistance at 91.00, where is the 200 days exponential moving average. I would say at this point still more pressure towards the downside, with risk seen on the return down to 89.83. That will open way for fresh weakness towards interim supports 89.28 and 89.00, ahead of our key support at 87.69, low of 3rd of October 2012. Hourly structure remains quite weak, but overextended conditions that produced this bounce did not give any stronger result. Approximately 30 between 23.6 and 38.2 has been retraced of the latest fall from 93.47 last Friday's peak to 89.83 this morning's low. Still more focused towards the downside, despite the indicators being deeply in the negative territory. Some regain of momentum is seen, not enough at this point, as the descending moving averages of 20 and 55 days one and the 10 days one now moving sideways, seeing more pressure towards the downside for the crude oil. And finally, the gold remains heavily under pressure. Negative downtrend shown on the 4-hour ADX study shows that the downside is firmly in focus. Developing a downtrend on the daily chart, also giving good signal for further extension. Lower as the penetration of daily 55 days exponential moving average, also 38.2% Fibonacci retracement of the upleg from 1590 to 1795 is a good signal for a further retracement of the latest upleg, as we lost 1750 and 1736 recent range floor, and the failure to regain 1800 as psychological resistance, despite posting fresh high at 1795, fresh yearly high, was not enough for the gold price to sustain gains, and subsequent easing now is looking as our initial target at 1717 has been dented. 1711 is the initial dynamic support, 55 days moving average, ahead of 1700 as psychological and round figure support. Of course, we have the 50% retracement slightly below at 1693, violation of which is definitely to confirm the corrective action is well underway and will open their way down towards 1668. That marks 61.8% retracement, and 1661 200 days moving average. That would be the near-term targets in case of a slide below 1700 as psychological resistance. On the upside, immediate resistance lies at previous low at 1728, with the price so far reaching 1726, so even the initial resistance stays intact for now, with the dynamic barrier at 1736, equivalent also to 20 days exponential moving average, equivalent to the previous low of 26 of September 2012. At this point, regain of level at 1755, that also marks the previous range floor, and close to 50% retracement would provide near-term relief and prevent pair from the further sliding, temporarily at least. Otherwise, any reversal under 1755 would be seen as a lower top, and will trigger the fresh weakness, with the downside targets as set 1700, 1692 initial targets. That was all from me for today. Please, if you have any question that I can answer, you can submit it now. Okay, it seems that we have no questions for Monday. Okay, beginning of the week, no problem. I would like to thank you all for attending our live session. A reminder for tomorrow, 1 at the same time at 7:00 GMT. Until then, I wish you a nice first day of the week and, of course, very good and profitable trading. Good luck.